to our video abstract. Today, I'm going to talk to you about our paper on rich fund flow. In this paper, we're going to study the relationship between the fund float and future performance. Our paper is motivated by the observation of the following puzzles. In the literature, it's documented that capital asset pricing model appear to be the one that used most by investors to direct their fund flow. Berg and Van Benzenberg conclude that since investors are rational in their framework, the capital asset pricing model must be the correct one to use to price fund investment. In other words, the capital asset pricing model alpha is an indication of manager's skill. On the other hand, Barber, Huang, and Oden, they also document the similar finding. However, they argue that the evidence that investors do not use more sophisticated model in directing their fund flow is an indication of less equipped to evaluate fund managers. In other words, investor seems to making a mistake. So the debate actually following these two papers are trying to resolve this puzzle, especially from the angle that why capital asset pricing model is not a good model in explaining cross-sectional variation of expected return, but investors still using it. Fund investor rational to use this model or not? The subsequent paper looking at the other information source on potential estimation econometric problem. The investor may not actually draw the right conclusions. In our paper, we take this puzzle in a different directions. We want to look at whether investors are able to know they are making a mistake or not by verifying the fund flow that's driven by this alpha model. How will this fund flow relate to future performance? Our research design can be summarized in two steps. First, we run fund flow determinant regressions. We estimate 5-year rolling monthly time series fund flow regressions, including both all the alphas and some non-performance determinants such as fund size, past fund float, and fees. After the estimations, we utilize the Shapley decomposition approach to obtain R-squared decomposition from the regressions. We then obtained the attribute R-squared to each of the alphas, and we call them alpha float. Once we obtain this alpha float, we can proceed to the second stage of regressions to analyze how fund flow that can be explained by those alpha can further explain futures performance. And here we also include various alpha or raw returns. And we look at the performance from short-term to 5 years horizon. So our framework consists of using alpha to predict fund flows, to generate alpha float, and then we use alpha float to explain future alpha. We can see this as like a complete cycle of alpha to flow and flow to alpha analysis. Just quickly on the sample and data, we get the data from Morningstar Direct database, which include about 2,000 US equity funds. We applied various standard filter onto the database. What are main findings? First, we show that fund flow driven by capital asset pricing model alpha is indeed the most consistent predictor of the short-term performance. In other words, investors are smart in using capital asset pricing models as the benchmark to direct their fund flow. However, investors do not just use capital asset pricing alpha as a skill measurement and trace the performance. They sometimes also use it as a contrarian signal to bet against the capital asset pricing model alpha. Since both types of fund flow, the momentum and the contrarian strategy, can predict future performance, it suggests that investors are able to switch dynamically to predict future performance. In our robustness check, we show that this is not just a simple result coming from an unconditional contrarian strategy by betting against capital asset pricing alpha. This concludes that investors are indeed smart in using this model for their fund flow decision. What are our main contributions? Regarding the CAPM puzzle, which alpha should be used? Our results show that among the performance tracers, tracing alpha from the simple models such as capital asset pricing model alpha or the market adjusted return actually will produce better performance than tracing alpha from other models such as Farmer and French three-factor model. In this regard, investors are making a rational choice when they decide which model to use when they decide to simply trace past performance, or we can say that they are using the alpha as a measure of managerial skill and tracing the manager who are able to produce the abnormal return. Although we still don't know why capital asset pricing model alpha can predict future fund return while it cannot predict cross-sectional stock return, but we know more about why fund investors will continue using this to direct their fund flow. It is because it can produce abnormal return for them. In this paper, we not just looking at capital asset pricing model as a momentum kind of indicator. So the alpha is not just measuring manager's skill. So if it's high, then it means the managers have skill, so we invest more. Our model able to capture the time that when investors systematically use this alpha as a negative signal, as kind of a contrarian signal. So when this performance, this alpha actually is high, they will actually sell the fund and vice versa. Or maybe they will invest in the fund that actually have low alpha, but they still get rewarded in the long run. So overall, we do find that capital asset pricing model is a model investors use most and get rewarded, but its success is not necessarily coming from the success of capital asset pricing model able to price cross-sectional price correctly. It's more that investors know how to use it and when to bet with it versus bet against it to obtain better fund performance. Thank you for your attention, and our paper is on SSRN and ResearchGate. If you have any comment, please feel free to contact me.